This is a podcast from the Business Times.
Wall Street fell into the red overnight, with all three major U.S. indices under pressure as oil prices surged and investors digested the latest round of earnings from major technology companies. Brent crude briefly touched $100 a barrel for the first time since May, after Yemen's Houthis attacked two Saudi oil tankers. Meanwhile, trade tensions are back in focus after the Trump administration announced new tariffs on 60 trading partners. So what does this mean for Asian markets? We're joined by our expert today to help make sense of the latest developments. Welcome back to Market Focus Weekly. I'm Clarissa Montero, standing in for the vacationing Howie Lim. It's Friday, July 24th, 2026. Mitul Kotecha, head of FX and EM Macro Strategy Asia at Barclays. Welcome.
Thank you for having me on the show.
What a day for you to join us, though.
Absolutely. So much going on. Unfortunately, quite negative factors for markets. And we're seeing that obviously impacting risk assets into recent sessions and likely potentially going forward as well.
When I was still working in banks, my desk head used to say, red means opportunity.
That's true. And I guess it depends. A lot of people may look at this as a buying opportunity, but there are also many trying to get out the market thinking this could get worse. But when you look at it on the face of it, markets are red for a reason. And there are various reasons at the moment that have spooked investors and clearly resulted in some increase in risk aversion.
Okay, so let's talk about one of the big ones. Brent hitting its highest levels in quite a while, actually, 100 US, and that's going to spook many different sectors, not just commodities.
That's right. Well, we've seen since early July, oil prices have risen again very sharply at a time when most people had thought that the MOU between the US and Iran would keep oil prices relatively well subdued. Oil had come off from a peak earlier of around $120 a barrel, all the way back down towards 70. And obviously, we've backed up significantly now to 100. And I think there is obviously the Strait of Hormuz, which remains effectively shut again. There is renewed attacks on both sides that are impacting the region and regional facilities, refineries, exporting capacity, etc. We're at a time when inventories in the oil market are also very, very low. And I think that is another factor that's resulting in this sort of magnified impact on oil prices at the moment. And the other thing really that's worth noting, it's not just oil prices, it's crack spreads that are very important. It's those refinery margins that have risen dramatically. And that means the impact on diesel, gasoline, etc., has also increased significantly in recent weeks. So you put it all together at a time when inflation worries are still relatively elevated. That's really spooked bond market. It's spooked interest rate markets generally. It's pretty impactful for this region, given that Asia is one of the biggest, or if not the biggest, oil importing region. Countries such as India, China are big oil importers, certainly in Southeast Asia. And so I think the impact is still feeding through here. It's obviously not a positive one.
And I would assume that this is not just a day trade sort of event. We're looking at this impacting into next week.
I think that's right. I mean, of course, a lot will depend on what's happening in the conflict in the Middle East. If there are signs of renewed easing intentions, that would likely result in lower oil prices. But at the same time, we don't seem to be moving in that direction. Some of the recent rhetoric, if anything, seems to be turning more aggressive. Potentially, we are seeing the conflict widening even more, with Houthis now having threatened shipping. And that is also adding to more sense of that the oil price, if anything, will continue to rise. Our house view is that oil will average $96 a barrel this year. So that is still at a very elevated level compared to what the expectations were pre the conflict. So to your point, it does look like oil prices will continue to be pushed higher.
Okay, since we got a new Fed chair in the US, there's been a bit of a watch there to see what impact that would have on rate hikes. What are you seeing? What do you think?
Barclays' view is that the Fed does not hike this year. But that said, the market is pricing in practically two hikes by early next year, 225 basis point moves from the Fed. And that, again, shows you that there is this worry that inflation remains elevated at present. And that is weighing on expectations and clearly resulting in markets expecting the Fed to have to tighten. We had a soft CPI release in the US recently, which did allay some concerns. But at the same time, Federal Reserve officials, including new Fed Chair Walsh, do sound relatively hawkish. And the first FOMC meeting, I think, surprised markets. First one, as in under the chair of Walsh, surprised markets by sounding a little bit more hawkish than expected. So again, I think markets are seeing this as warning of potential rate hikes ahead. But like I said, we still think there's a chance that the Fed may hold in the next few months.
What do you think that means for Asia specifically with central banks? Do you think that they're going to be forced to keep rates higher to defend currencies?
I think this is the problem that some countries in the region have had to hike rates pretty aggressively to maintain some defense of FX. Indonesia is a prime example. Bank Indonesia has hiked by 100 basis points in recent months to help defend the currency. And at the same time, the rupee has still been under pressure, although some of that has been allayed in recent weeks. So we have seen hikes in the region. The most recent ones have been, for example, Bank of Korea, not necessarily because of the currency weakness, but more because of the strength in exports and strength in growth. But what I'm trying to get at is that the region is at a period of relative rate tightening here. We've seen a number of hikes across Asia. And like I said, Asia is very exposed to high oil prices. So the risks, if anything, are moving to the top side on inflation in this environment.
And the US dollar is very dominant right now. It's holding a near 40-year peak against the yen. That can't be good for the region.
That's right. The dollar broadly is strong. Part of that strength has come from higher US yields, and we talked about markets pricing in Fed rate hikes. Secondly, higher oil prices generally bode well for the dollar as well. And that's not good for the region, as you say, because a firmer dollar hurts currencies in Asia. To some extent, that it's helpful from an exports perspective. But on the other hand, it also means higher imported inflation costs. And so Asia is quite wary of allowing too much FX weakness amidst a broadly strong dollar. But as I said, dollar is strong. It's hard to see that reversal in the dollar anytime soon. And therefore, it's going to continue to play more negatively for a lot of, not just Asia, but for a lot of EM currencies, especially low yielding currencies that don't have that defense of higher interest rates, as, for example, Latin American currencies do. And that could be a much bigger problem for Asia, which is generally a low yielding region.
Okay, let's move on to what should have been the top line of this conversation. It is earnings season. So, do you think that another strong earnings season could reignite growth, but also inflation pressures, especially within the tech sector, semiconductors and such?
Well, I think there's clearly a lot of focus on US tech earnings. And at the moment, one of the reasons the market is a bit more nervous is the massive AI capex spending that's going on. And not from the point of view that it's a bad thing, but the question is it going to deliver the returns that had been previously expected? If you look back when companies announced very strong capex spending, it generally boosted the share price. At the moment, there are a number of question marks about how much of that capex spending is going to deliver actual returns. And while this capex spending is a big driver of US growth, last year it drove almost half of the US economic growth, these questions are weighing on equities at the moment. It's one reason why we're seeing tech underperform in the US. Chip stocks in particular have been weighed down, and we're seeing that more recently. So I think it is something that we will continue to focus on, in particular the tech earnings outlook.
So, this morning we all woke up to the news of new tariffs. They're back in focus. Are Asian supply chains better prepared today to absorb this new wave of trade tensions?
Well, I think it's interesting because prior to President Trump's tariffs being struck down by the Supreme Court, the tariff impact hadn't hurt this region as much as been previously anticipated. In fact, exports, when you look, for example, from China, held up extremely well. But what happened was that the exports to the US had weakened, but exports to the rest of Asia had strengthened. Yes, some of that is transshipment and re-exporting, but Asia was benefiting from this re-exports as well, where a number of countries in Asia saw very firm exports demand, particularly, and again, going back to what we were talking about earlier, the chip and technology exports in countries such as Korea and Taiwan, but even countries such as Vietnam, which was a big beneficiary of these re-exports, had held up quite well. So Asia, to your question, holds up better than had been feared. And now with this new round of tariffs that have been announced, clearly there will be some hit to growth, but I don't think Asia is going to be as concerned as the region would have been previously.
All right, still to come, we zoom in on two Asian currencies, the Japanese yen and the Indian rupee.
Market Focus Weekly, now hosted by Howie Lim. A sharp weekly deep dive into what's moving markets in Singapore and across the region. With analysts and market insiders to break down the forces shaping the week ahead. New episodes every Friday, powered by the journalism of the Business Times. Find Market Focus Weekly wherever you get your podcasts.
Welcome back. It's Market Focus Weekly. We're speaking to Mitul Kotecha, Head of FX and EM Macro Strategy Asia at Barclays. Mitul, let's turn our focus to the news out of Japan this week. Inflation and the Purchasing Managers Index. PMI numbers were just out this morning, while the yen slid past 163 per US dollar to its lowest in 4 decades. So let's turn our attention to the yen. It is being impacted. Where's this line in the sand for the yen?
As you mentioned, dollar yen has continued to move higher. Markets are wary of intervention from the Japanese authorities to drive dollar yen back lower, but so far that intervention has not been forthcoming, at least in recent weeks. The problem, I guess, for the yen at the moment is Japan has relatively low real yields. At the same time, the yield differential with the US has been widening. Markets are also, to some extent, concerned about fiscal path in Japan and potential for a widening deficit and extra budget spending, which could also weigh on the long end of the JGB curve, as well as Japanese yen. So in this environment where real yields are relatively low, it is difficult to see how dollar yen can turn around. And so that move through the 163 levels, at the moment, we're seeing that continued trajectory higher, albeit gradually, on dollar yen. And I think there's probably another reason why we've not yet seen the intervention, and that's because the move has been gradual. Volatility is another factor that the authorities may look at in Japan, and volatility has been kept relatively well subdued, even with this move higher in dollar yen. So yes, there is wariness. We could see potential intervention. There has been some talk or jawboning from Japanese authorities. There's also been talk about these GPIF inflows and reallocation back to Japan, which could also be helpful for the yen, but at the moment, none of that has been forthcoming.
Japan's fiscal position is coming under increased scrutiny. When do you think the investors will be genuinely concerned?
I think we have to see some clarity on the fiscal plans because there has been, again, talk of additional stimulus. And we know that the Takaichi administration clearly wants to boost defense spending and spending in other areas where there may be some concern. But at the same time, some of this increase is still measured. Markets will try and assess whether and how this will be funded. But yes, there is a focus on the fiscal picture in Japan and whether the more aggressive fiscal expansion plans result in pressure on Japanese bonds. And that pressure would only come if we do see worries about financing. So it is something that's very much in the investors' minds. We've seen that impact on rates markets in Japan. And for now, we wait to see how these plans develop.
Okay, let's move on to India. Do you expect further weakness in the rupee, particularly if that US Fed stays hawkish and oil prices remain elevated?
I think for India, the Reserve Bank of India have done some very, very significant measures in recent weeks to try and attract capital flows into the country. This FCNR deposit scheme, plus the commercial borrowings of the banks and more ease for allowing investor flows into equities and bonds, have all been quite significant. And we believe that's taken the tail risk out of the rupee. And therefore, that sort of sharper pace of depreciation of the rupee that we saw just a few weeks back now is unlikely to happen again. That said, the rupee is quite vulnerable to higher oil prices, according to our analysis. And unfortunately, oil importers have ramped up their oil or dollar buying because of the increase in oil prices. And that's led to further pressure on the rupee as well. So we do expect depreciation to continue, but we expect it at a gradual pace. We don't look at the sort of rapid depreciation pace that we saw previously. And unfortunately, despite a potential reversal to a much healthier balance of payments position because of the RBI measures, the problem is that higher oil prices are continuing to weigh on the currency.
Okay, before I let you go, it is right now pretty much a sea of red across Asia. Next week is a new week. What should investors be looking for as signals?
Well, again, at the moment, there's so many different conflicting factors out here. What's happening with oil prices in particular, we talked about whether there's going to be a de-escalation between Iran and the US. Some steadiness in the tech sector. Obviously, the earnings will be in focus of big tech names, as well as generally just some sense that the equity market is stabilizing here. But there are just so many other factors at play that it's hard. You need to see a few of these come together to get some stability in markets. I'm wary that we're also in summer. We see liquidity thin out a little bit more as well. That could exacerbate moves. So again, I think you have to remain very, very nimble in this environment.
Thank you so much for that. Mitul Kotecha, Head of FX and EM Macro Strategy Asia at Barclays.
Thank you.
That's it for this week. Market Focus Weekly. Check in at the end of every trading day for updates on the biggest moves and news in Market Focus Daily. If you have any questions or feedback, drop us a note at btpodcast@sbh.com.sg. Till next Friday.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.